On January 1st, 2007, Rob Wilco Company purchased 200,000 8% bonds of Mercury Company for $184,557. The bonds were purchased to yield 10% interest. Interest is payable semi-annually on July 1st and January 1st. The bonds mature on January 1st, 2012. Rob Wilco Company uses the effective interest method to amortize discount or premium. On January 1st, 2009, Rob Wilco Company sold the bonds for $185,363 after receiving interest to meet its liquidity needs. And I see liquidity is spelled incorrectly, so assume it's spelled correctly. Part A says, prepare the journal entry to record the purchase of bonds on January 1st. Assume that the bonds are classified as available for sale. And now you see the solution in front of you. How we make this entry is we record a debit to available for sale securities equal to the $184,557, the amount we paid to purchase them, and we used cash to buy them. Next we tackle Part B, which asks us to prepare the amortization schedule for the bonds. Now a video will show up, and when it does, you'll have some controls near the bottom. If you mouse over to it, you'll be able to see the controls, and then when you mouse off, it will disappear. So you can sort of toggle back and forth to watch the video. Okay, now you see the starting of the amortization schedule in front of you, and we've dropped in the $184,557 of carrying bonds right there. Now we know they were issued to yield 10% when the bonds were at 8%. So to come up with the either the interest receivable or the cash received amount, we would take the face value of the bonds, 200,000, times 8%, and it's paid semi-annually, so we divide it by 2, or essentially multiply by 4%, and we come up with $8,000. Now, I'm not going to use decimal places here. And that would be the same for all periods. And what I'm going to do is put the full amortization schedule together. So here's a little Excel trick. Once we have the first two dates, Excel can figure out the timing. So if I drop down to here, it'll drop it in, hopefully by the proper dates. Oh, and the only thing I needed to do, though, is make this 12/1. I see now, 12/31/07. And I'm not so sure Excel will know how to do that, but let's see if we can just copy from here and see if it figures it out. Yeah, it's missing it by one date, so that should be 12/31/2009. And that would be 12/31/2010. And this would be 12/31/2011. All right, that looks correct. Let's make that left justify so it's a little bit easier to read. Okay, and then the 8,000 payment is the same for all periods, so I'll just format that. And you can see I'm just referencing from the cell above, and then I'm just going to copy it down. Okay, so now I've got the payments done. The interest revenue we're going to record on this investment is going to be equal to the prior amount balance times the yielded interest rate given. It's 10%, but semi-annually, again, we divide it by 2. And we come up with 9227.85, but I'm going to get rid of the decimal points. And what that means is we've got a discount amount of the 9228 minus the 8,000, or 122,785. Let me format that, flip that over there. And then to determine the running balance, we take the carrying amount, and then we add in the discount, because we eventually want to bring the carrying amount up to the full, up to the face value of the amount. So that goes to 185,785. Now, if I've done this correctly, all these formulas are in here correctly, I can simply copy from down below, and then later on I'll get rid of the dollar signs. We won't need those. So if I just take that and copy and paste it down to here, I think what we're going to do is eventually make our way to 200,000. Yeah, we're off $1. I'll leave that just as is due to rounding. And then from here on down, we'll get rid of the dollar sign by going to this format right there. Oh, and if I slide down a little bit, by the way, the total bond, we could come up with the total bond discount and amortization. Let me slide this down just a minute, and I'll jot in the total. So I'm going to go like from here to here. We'll just use the sum, turn that to dollar sign, get rid of that, and maybe underline these. And there we come up with the totals, which probably we should double underline probably as well. Now my formatting isn't perfect actually. Maybe the better way is to right click, hit Format Cells, you get this little pop-up screen, and you go to Double Accounting Underline, then you hit the OK, and now the formatting looks perfect. And that's part 2, which tells us how do we put together an amortization schedule. Okay, next on part C, they've asked us to prepare the journal entries to record the semi-annual interest on July 1st and December 31st of 2007. Okay, so on the screen I've got just the rows that relate to those time periods from the amortization schedule we just put together. And then now as you look near the bottom, you can see the solutions. So we've got an increase in cash of $8,000 on July 1st and then again on December 31st. And we've got an increase in the value of our available for sale securities equal to the bond discount amortization amount. And when we add those two together, we come up with the interest revenue that we need to record in each of those time periods. So we record one on July 1st and then the other on December 31st. Okay, next part D says if the fair value of Mercury bonds is $186,363 on December 31st, 2008, prepare the necessary adjusting entry, and we are to assume the security's fair value adjustment balance on January 1st, 2008, so the beginning of that year, is a debit, and that should say of $3,375. Alright, now what I've done is dropped in the amortization schedule that shows you what the carrying amount of the bonds would be as of December 31st, 2008. And with that number in front of us, we then can show the solution. So what we've got to do is show that the available for sale portfolio cost is equal to $189,849 according to our amortization schedule. We've now been told that the fair value is $186,363, so we've got an unrealized loss of $3,486. If the previous security's fair value adjustment had a debit balance of $3,375, then we need to make an adjustment in the amount of $6,861 to bring the security's fair value to the proper amounts. And as you look on the bottom of the screen you're looking at, or the window you're looking at, you'll see the entry: a debit to unrealized holding gain or loss dash equity on securities of fair value adjustment of $6,861. And then we, of course, decrease the available for sale securities fair value adjustment by that same dollar amount. And finally, we tackle Part E, which asks us to prepare the journal entry to record the sale of the bonds on January 1st, 2009. And now you see the solution there. So on January 1st, 2009, the selling price of the bonds was $185,363. That was given in the problem. The amortized cost, according to our schedule at that point, was $189,849. So we had a realized loss on the sale of investments, and these are available for sale securities, of $4,486. With that knowledge, we can make the entry on January 1st, 2009. We receive cash of $185,363. We record the loss on the sale of the securities, and that's equal to the realized loss we just computed, so that's a debit. And the credit then will eliminate the value of the available for sale securities that we've got appearing in our financial statements.